A fresh start and new beginnings are exciting opportunities that each new year presents, such as in the world of investing. After going through a rough year for the stock market, we can now set our sights higher this year and forget about the amount of money we lost last year. The year 2022 started off with relatively bullish market expectations, but soon after, rising inflation, interest rate hikes, and recessionary fears took hold, making it a year to forget for both fixed income and equities. The S&P 500 lost 19.44% in 2022, which was the worst year since 2008. However, there is always that one individual who, for years, has consistently managed to outperform the market. Can you identify who that person is? Well, it's obvious from the title, but Warren Buffett, the man and the legend, is the real deal. So, in this video, I will be sharing Warren Buffett's 5 rules for success in 2023. But before I move on, please remember to like and subscribe to the Finest Professor's YouTube channel. Thank you! If you're interested in finance and investing, I'm sure you've already heard of Warren Buffett. But in case you don't know who Warren Buffett is, he is currently regarded as the GOAT, or the greatest of all time in the world of stock market investing. As a matter of fact, he almost always outperforms the market each year. Yep, even during the last 3 recessions. Assuming he had invested $1,000 when he first began, he would have amassed more than $30 million by now. And in 2022, even though the market was down 19.44%, he was up 3%, outperforming it once more by about 22%. Warren Buffett once said this in an interview.
The first rule in investment is don't lose. And the second rule in investment is don't forget the first rule, and that's all the rules there are.
Coming from the GOAT in investing, isn't that one of the critical mindsets every investor should have? In addition to this, here are the actual rules to follow according to Warren Buffett. Rule number 1. Never make an investment in businesses you don't understand. This rule may sound quite familiar as he has told this to so many people many times in the past.
Only should expect to make money in things that I understand. And when I say understand, I don't mean understand, what the product does or anything like that. I mean understand what the economics of the business are likely to look like 10 years from now or 20 years from now.
You need to have a thorough understanding of how a company's future financial performance is likely to pan out before you invest in it. For instance, if you want to invest in a clothing company, you should be aware of how the industry will change over the next 10, 20, and 30 years, as well as the competition. Since he had no idea which company would succeed in the future, Warren Buffett avoided investing in tech companies as a result of this rule. That simply indicates that he doesn't understand the industry well enough to invest, not that he doesn't enjoy using the goods and services provided by those businesses. Therefore, if you don't understand the business, don't simply buy Tesla shares because they are inexpensive. Always do your research before making any financial decisions. Rule number 2. Focus on the intrinsic value of a company and avoid emotions. Here, Warren Buffett advises investors to attempt an objective evaluation of a company rather than allowing their emotions or biases to guide their investment decisions. The term intrinsic value refers to a company's true or inherent value, which may differ from its market value, the cost that is presently trading for on the stock exchange. Investors can take into account a number of factors, including a company's financial statements, competitive advantage, management team, and potential for future growth to determine its intrinsic value. According to Buffett, investors can make more informed and logical investment decisions by focusing on a company's intrinsic value as opposed to the market's perception of it. Additionally, Buffett advises investors to stay away from the emotions because they can result in irrational decision-making. An investor may be more likely to act hastily and without carefully considering the company's fundamentals. For instance, if they become overly optimistic or pessimistic about a company. Buffett believes that investors can make more rational and successful investment decisions if they put aside their emotions and focus on a company's intrinsic value. Rule number 3. Seize big opportunities.
big opportunities in life have to be seized. We don't do very many things, but when we get the chance to do something that's right and big, we've got to do it.
The things Buffett knew he should have done but chose to do nothing about were his biggest mistakes. You must seize big opportunities. Sometimes you just have to take the risk and seize the opportunity if there is a company that you are familiar with and you believe it's undervalued. But as stated in rule number 1, you need to fully understand the business you are getting into. Just because GameStop or AMC seems undervalued doesn't mean you should buy it. You must be familiar with the industry. Warren Buffett previously made a mistake in this area and lost billions of dollars as a result. Rule number 4. Be fearful when others are greedy and be greedy when others are fearful.
But they buy a stock and they think if it goes up, it's wonderful, and if it goes down, it's bad. We think just the opposite. When it goes down, we love it because we'll buy more, and if it goes up, it kills us to buy more.
When Warren Buffett says to be fearful when others are greedy, he is referring to market psychology. When investors are fearful and share prices decline, it can present good value investment opportunities. On the other hand, when markets are performing well, investors may grow irrationally greedy and keep buying assets, pushing up prices and causing asset bubbles to form. However, when these bubbles eventually burst, those who had invested during the bubble suffered sizable losses. As a result, it's critical for investors to be aware of these emotional biases and base their investment decisions on thorough research rather than letting their emotions guide their decisions. Additionally, this holds true for the reverse circumstance. Many assets may become undervalued when people are fearful and the market is falling. Thus, it is crucial to be greedy when others are not. Rule number 5. Invest in yourself.
Generally speaking, investing in yourself is the best thing you can do. Anything that improves your own talents. Like, nobody can take it away from you. They can run up huge deficits and the dollar can become worth far less. You can have all kinds of things happen. But if you've got talent yourself and you've maximized your talent, you've got a terrific asset.
Buffett's advice emphasizes the importance of continuing to learn things that will benefit you as a whole person, not just as a financial investor. In addition to getting more education or training in a particular trade or skill, every day of your life should be spent working to improve your knowledge and skills. Never stop learning new things that interest you. Go to bed a little smarter each day is one of the famous tips Warren Buffett considers the key to his success. Well, that is for today, folks. Thanks for watching, and I do hope you enjoyed this video and found it helpful. If so, please hit the like and share button so that many people can see this video and learn from it. Also, please subscribe to our channel if you haven't already and click the bell notification button to receive updates on our videos. See you next time. Bye!